How much revenue do you actually need to IPO in 2025? It used to be that if you built a good company, showed solid growth, and had decent unit economics, you could go public. But today, the bar has been raised big time. I want to take you through a trip through time over the last 15 years of relevant tech IPOs, put today's market into context, and we'll zoom in on the most recent companies to go public. Is this thing on?
Yesterday's price is not today's price.
Ben, good to see you.
You too, CJ. Good to be here.
Well, welcome to Mostly Media. We're like a real company now, Ben.
Yeah, no, it's intimidating but freeing at the same time. It's all going in the history books of Mostly Media.
So, producer Ben,
Yeah,
newest hire at the company.
that's me.
I'm gonna call you producer Ben, but like you're a benevolent, creative dictator. Does that sound right?
Yeah, well, you can just call me dictator.
Dictator Ben.
That works. What are we talking about today?
So I keep a really close eye on what companies are gonna IPO, and a ton of people are asking me lately, how much revenue do I actually need to be a public company now? And I think the bar has changed. And I kind of want to take you through the history of where we were maybe 10, 15 years ago and how we
Sure.
got to where we are today.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
You may know that we use Campfire as our ERP at my company, Mostly Media. And it's been a game changer for our finance workflow, coming from the guy who does it all. The interface is intuitive, migration was quick and painless, and it's freed me up to focus on strategic work instead of manual processes, like, making content for you. In case you don't know, Campfire is an AI-first ERP powering next-gen finance and accounting teams. They help you close fast, unlock insights, and scale smarter. Seriously, the metrics and P&L views that I'm pumping out of the system are nuts. And you can tell this thing is scalable for companies who have multiple entities, complex department hierarchies, and various product lines. If you're curious about where finance tech is heading, I am, and would like to hear more of my thoughts on the topic, don't miss Campfire's Finance Forward AI Summit, the upcoming summit bringing together the sharpest minds in finance and operations. You'll hear directly from industry leaders on how they're using AI to shape the future of finance and how your team can get ahead of that curve. I'll be speaking on panels with finance leaders from Anthropic, Snowflake, Mercury, and more. The summit is October 28th in San Francisco. I hope to see you there. Sign up for the summit at campfiresummit.ai or learn more about Campfire at www.campfire.ai.
Can we maybe dive into why a company might even want to IPO? Like, why not just stay private forever? What's the value in you IPOing?
That's the billion-dollar question. And the answer, honestly, for a lot of companies is I actually don't want to go public. And it used to be you would IPO to give early investors liquidity, right? They can trade their shares, give early employees liquidity. It would be a kind of like a coming out party for the company where it's this huge enterprise opportunity to basically put a logo on a deck to say, we're on the New York Stock Exchange, we're on the NASDAQ, we are legit, so you should buy our security product or our note-taking app. But honestly, something that I learned from talking to Howard Wilson, who took PagerDuty public, is it's also like a credibility and transparency play if you provide critical infrastructure to somebody else's company. So think about it, if you're like a CrowdStrike or a Cloudflare, companies depend on you to be their like security backbone to make sure that they're always up. And so if you're kind of the fallback for that, a lot of companies are going to want to be able to say, can we see your financials just to make sure that you're also going to be a going concern? But like there's this eerie trend going on where 30 years ago, there were 8,000 publicly traded companies in the US. We are now below 4,000. So it's halved in that time.
Is the thinking too, when you're IPOing, we're going to bet that we're going to be successful in the future? Is that the thinking, is like, we're kind of like betting on the future of the company based on like current performance?
We're publicly betting on what we'll be able to do. You're basically naked when you're public. People can see your results, and it's a lot harder to make shifts to the company. A lot of times when companies cut headcount, that's like a bad sign, and your stock price will go down. If you're private, like you can make changes internally and nobody's going to bat an eye because you're not what they call mark to market every day. right? Investors can't change their valuations. And if you're not raising capital, you don't have to catalyze the reality of the conditions that you're in a
Right.
particular market. So you're definitely betting on the long-term stability of the company, and you want to be rewarded by your stock price going up. But it does come with a lot of red tape and a lot of eyes.
Well, let's go through some history and figure out what the answer is here.
All right, so I'm going to take you through how much revenue do you actually need to IPO in 2025. And it used to be that if you built a good company, showed solid growth, and had decent unit economics, you could go public. But today, I would argue that the bar has been raised big time. And so let's take a trip through the last 15 years of tech IPOs to put today's market into context and zoom in on the most recent companies to go public. So I want to start with the 2010s. Companies could go public with much smaller revenue levels. You had the likes of RingCentral in 2013. They had only 136 million in trailing 12-month revenue. Then you had Etsy in 2015 with 195 million in revenue. Twilio came in 2016 with 167 million. So keep those numbers in mind.
Are these companies are we looking at a high level here? On average, how many companies are going public a year?
It's a great question. In some years, it's basically none. In other years, there's one every week. And we have this glut of companies that thought they were going to go public. But if you said, by some miracle, we're going to have one company every single week of the year, 52 companies go public, it would still take us 6 years to digest all those companies, right? Because there's over 600 of them out there that achieved valuations north of $1 billion and were proclaimed unicorns and had expectations of going public. So I think the number has been thrown off by a good amount, but like in any year, I think you could hope for like 20 solid IPOs in a very good year.
Cool.
And so those companies I mentioned, Ben, they were early movers in their industries. RingCentral was riding the wave of cloud-based communication. Etsy brought the artisanal e-commerce niche to Wall Street, and Twilio was part of that early cloud infra as a service boom, if you remember, where companies could IPO while still deep in the red so long as they had a path to scale. And back then, the median IPO revenue hovered between like 100 million and 250 million in revenue, and that was enough. And they also weren't trying to raise billions of dollars in capital because these two concepts are intertwined. Twilio raised 150 million in capital at a 1.2 billion valuation, which would be extremely small today, which was considered impressive back then. But by the late 2010s, things changed. Investors started expecting bigger numbers, stronger growth, and clearer profitability paths, and companies wanted to raise even more dough.
I'm looking up over here on the side. Wasn't it when Uber IPO'd? Like, have they ever been like a profitable company? Are they even making money right now?
They didn't make money for like 3-4 years after they IPO'd. Like they were deep in the red.
So is the speculation there? It's like, oh, they'll eventually make money. And we're going to like, coming back to what we were talking about in the beginning, like the reason that Uber would IPO, even though they're not profitable, they might make money in the future. I mean, that's the mentality.
We're going to make it up in scale, brother. Make it up in volume. That's what they say. But I mean, eventually they were able to flip the switch. And I do think like, I've gone back and forth, like, was it their marketplace model? And it reminds me of a lot of AI companies today that are operating at what you would call a negative gross margin, basically like swapping $1 for 75 cents on every transaction. But I think it was more endemic of the times where like, if you have a choice to grow through cheap capital, you take that. It doesn't matter if you're a marketplace, cybersecurity company, or anything else.
For sure.
So if you think back to 2021, that was like an IPO bonanza year. I remember it was COVID. I was locked up and I was just like refreshing my Google Chrome browser over and over again because 1,035 companies went public globally. And it wasn't just about quantity. Some of the biggest IPOs of all time happened in 2021. So I'm going to hit you with some household names, Ben.
Give it to me.
We had Coinbase at 1.3 billion in revenue at IPO. They were riding the crypto boom. They went public actually via a direct listing, which is a specific type of structure to go public with less like investment banker red tape, less lockup for employees. And they hit a market cap of nearly 86 billion on their first day of trading. It was one of the largest debuts ever for a fintech company.
Crypto was very, very hyped at that time. And so just based off of your recollection, was this them, were they prepared to go public, or do you think that they accelerated the timeline a little bit to kind of match the hype of the industry they were at the time?
Their revenue was definitely there. I think there was a lot of skepticism though around their business model because like crypto was very unknown back then. And I think like when there are exuberant times, you get a longer leash to put a company out there with like a monetization method that's new or a sector that's maybe like looked at as a bit more dangerous. Like DraftKings comes to mind. They went
Yeah.
public via SPAC. That's because like it has some hair on it with regulation.
You probably have more insight into this than I do. I feel like the IPO strategy then was also we were stuck inside and maybe we're feeling a little bit optimistic and so wanted something to look forward to a little bit.
Yeah, a lot of these became events. I mean, I
Yeah.
was treating it as such, and like this was truly the rise of the retail investor. This was when Robinhood was booming,
Right.
and
Right.
was in
Right.
the-
Right. Right. GameStop. That was like that era as well. I know they
Yeah.
were already public, but like it seemed like people were just like a little more in tune because they had nothing else to focus on. I remember that was the year that I probably paid attention to the NFL draft more than any other year, just because it was something to look at.
we needed anything. And so
Yeah.
the next company was Airbnb. They had 3.4 billion in revenue at IPO, former Y Combinator company. That's also a lot of cleaning fees. 3.4 billion in cleaning fees. Despite travel taking like a total nosedive during COVID, they rebounded hard and went public at the end of the year with one of the most anticipated IPOs of the decade.
Yeah.
Wow. Okay. Wow. So 3 Y Combinators in a row. Then DoorDash, 2.2
Yeah.
billion in revenue at IPO. And they were fueled by the pandemic-driven food delivery boom. DoorDash went public with massive growth numbers, while questions definitely loomed about long-term profitability because they were basically delivering Outback Steakhouse blooming onions for like 60 cents on the dollar.
It's so wild that Airbnb is the largest. Like, is that looking at like last 12 months in revenue?
That's a great point.
I'm just so confused at how that revenue is so high during the pandemic.
I'm giving last 12 months in revenue. The quarter I think they IPO'd was definitely down because like nobody could use like an Airbnb, but then it took off after that. And I'm actually using last 12 months of what you call GAAP revenue, generally accepted accounting principles, rather than ARR. So
Okay.
just real quick, ARR is like the balance of contracts at any given point in time where you annualize it, whether you annualize the last month or the last quarter. So you're multiplying by either 12 or 4. And think about that as like your exit run rate. It's going to be the largest number. LTM GAAP revenue is like what you've actually done already. So your ARR is always going to be larger than your GAAP revenue. But because like Airbnb doesn't have ARR, like I don't,
Yeah.
like I use them more than once personally, but like that's not recurring revenue. Same thing
Right.
with Coinbase. And so at this point, the median revenue at IPO had skyrocketed. What used to be like a 250 million threshold was clearly now 500 million plus. And companies were raising billions of dollars, and that became the norm. And then the music stopped.
Phew.
Interest rates went up, growth stocks crashed, investors got super skittish, and suddenly the IPO market just like completely dried up. And in 2022 and 2023, we basically had no major IPOs because companies that would have gone public at 200 million in revenue weren't getting the valuations they wanted. And some of the companies that IPO'd in 2021, they were brave, they tried, they faced some brutal corrections. So like Affirm was one of them, buy now, pay later. They soared to $168 per share, only to crash below $9 in 2022 as interest rates rose and growth stocks fell out of favor. They have rebounded since to over $80 and now traded a super healthy 9x forward revenue, proving that some high growth fintechs still have staying power, but others like Blend have not been as lucky.
What's Blend?
Blend is a mortgaging company, so another
Okay.
fintech player there.
Well, I feel like that's probably tied to the interest rate problem specifically with like, I feel like your whole existence is tied to interest rates.
It's all connected, like Matthew McConaughey, time's a flat circle. And so then for 2 years, companies that could have IPO'd stayed private because no one wanted to debut into a brutal market, especially when they saw what was happening to companies who'd recently snuck in with revenues closer to 100 million. So darlings like JFrog, SentinelOne, and PagerDuty, who are around 100 million in LTM revenue, were getting crushed then. They were at like super high, frothy valuations, more than 50x forward revenue, and then they get pummeled in 2022.
Interesting.
In 2024, we get this rebound, but we have a higher bar. So we're back, but only if you're big. Reddit went public at 804 million in revenue. Klaviyo went public at 585 million in revenue. Rubrik at 628, and Instacart 2.9 billion in revenue. That is approximately 1 billion watermelons and boxes of Dasani water delivered on a bicycle in New York City, by my math.
I think your valuation of watermelons is very high. I think they could probably go public today.
Well, I mean, these numbers aren't just higher, they're double what used to be normal, Ben, pre-COVID. And that's
Mhm.
where I thought it was interesting that OneStream came in. They IPO'd last year with just 400 million in LTM revenue. Their ARR, which I said I wasn't going to talk about, but here I go, was 500 million. So that's a good one for the slide.
Mhm.
But they were testing whether the market is finally willing to entertain smaller IPOs again. Then we had Service Titan, the operating system for the trades vertical software. They pulled up from the parking lot at 700 million in GAAP revenue and 800 million in ARR. And then finally, we're getting to 2025. SailPoint back again, cybersecurity firm, went public. Ben, if you like SailPoint the first time, you're gonna love them the second time.
Oh yeah, we're back.
And they were at about 700 million in LTM GAAP revenue and 800 million in ARR. So, like, if you smell what I'm stepping in here, it feels like we're honing in on that minimum of 500 million to 700 million range as clear for takeoff, but not without risks.
If we go back like, I don't know, 100 years or something, how has it ever gone down? You think this like median or the average, like or is it just always kind of like going up? It's like the NASDAQ, it's just 10% returns year over year.
It's always gone up, and I think it also follows inflation to a certain degree. But more importantly, it follows how much capital you need to run your company. So people forget that going public is a form of a fundraising event, right?
Right.
You're raising money. Some of it like doesn't actually go to the company. It's what they call secondary shares. It's like you're an employee, you sell your shares, somebody else takes them. Nothing goes in the balance sheet to operate the company. But like people can't forget, an IPO is a fundraising capital event, right? And so if you need more money to run your company, you need a higher valuation to get more money without overly diluting yourself.
Yeah.
And so now we're like at the present day. Since then, we've seen the following companies go public. So CoreWeave, 1.9 billion in revenue in FY24, growing at an eye-watering, I had to triple check this, 737% year on year.
It's bananas.
It's a good year, right?
Yeah.
Klarna filed in March, but then they pulled back. They were at 2.8 billion in revenue in FY24, growing at 24%. I think they're going to finally go public this fall. And then StubHub, it was just the week after that. They also filed in March, and they also pulled back. Then they refiled in July with worse numbers than they had before at 1.8 billion in LTM revenue, growing at 19%. Chime, 1.7 billion in LTM revenue, growing at 31% year on year. Figma, this one blew the doors off. If you remember, Ben, 812 million in LTM revenue, 912 million in ARR, growing at 46%. All right, what do you think their stock price was up on the first day?
25%.
157%.
I'm way off. I'll get the next one.
You did the bro thing though. You went low.
That's me, Burly Ben over here. Do you think that in a way the failed Adobe acquisition helped with their revenue? Because they got like the cachet of being associated with Adobe, like, oh, like you're being kind of like, I don't want to say like supported by Adobe, but you're in the Adobe ecosystem. And then when that like kind of fails, I guess I could see how maybe like there'd be a little bit of a stink on Figma after that kind of falls apart. But I'm looking too, and if Google search is correct, who knows if this is the right number. The revenue for 2022 was like 250 million, and then like their revenue was way higher. Like I'm curious how that Adobe piece played into their revenue growth here.
Yeah, so they got a $1 billion breakup fee. So Adobe
Oh,
had to
right,
pay them
right.
$1 billion.
Yeah. Okay. That'll help.
It helps, but like I honestly think they did the hardest thing ever, which is mentally preparing yourself to go at it again.
Yeah.
And like to go from 250 million to over 800 million in that like 3-year time frame just to execute then is so hard. Like I've sold a company before, and you can't help but like thinking like when that deal is on the table, what does this mean for me? You start to think about like the number in your head. You start to think about like you're probably not going to work there anymore if you're in certain positions. Like to come back from that is nuts. And then to like, they grew like a banshee after that. Like I give them a lot of credit after like thinking that it was just going to like be a whole different ballgame. All right. And so the next one on tap is probably going to be Netscope, cybersecurity company. They're the most recent one to file to go public. They're weighing in at about 616 million in LTM GAAP revenue and 700 million in ARR. And importantly, they're growing in the low 30%. So it begs the question, what's the median revenue across the last 10 companies to IPO? I did it myself in a spreadsheet. This is where I think a graph comes up. It's 823 million, and your growth rate should be around 30%. But perhaps the real takeaway is you should be within 1 billion in revenue in the next 12 months. So you should be growing more than 30%. And I think like the final takeaway here is the new IPO playbook is like, can you credibly get to $1 billion in revenue within a year of going public? Okay. So you could be at 500 million and growing 100%. That would be nuts, and get to $1 billion. But like, you have to be, I think, within that $1 billion range. And why do I say that? Like, yes, you could IPO at 100 million in revenue, technically, but you're fighting an uphill battle to thrive in the public markets, which partially trade on attention. To get coverage from sell-side analysts and actually move the needle in institutional portfolios without requiring investors to take massive positions, you need a market cap of at least 5 billion. Some people I've talked to said you even need 10 billion. That's the new standard.
Okay, so why is that the case? That seems like a crazy jump.
Well, institutional investors, think like a Franklin Templeton, BlackRock, a Fidelity, they're throwing around, like I think Fidelity has over $2 trillion in money under management. They can only hold so many stocks in their portfolios. It becomes like a utility productivity. Like you can't be in every single stock. And each of those companies needs to be capable of returning meaningful capital, but without being overly concentrated in a way that they would be unable to unwind from quickly in a pinch.
So size matters.
Size matters in 2025. And to tie that back to revenue, if you're lucky enough to command a 10x valuation, that means you need at least 500 million in revenue to clear a 5 billion valuation. And even better, if you can credibly claim a path to 1 billion within the next year, like I said. Rubrik, they did it perfectly. Within the first couple quarters of going public, they exceeded $1 billion in revenue, and they made it so they didn't fall out of favor. And if you look at their stock, it's up more than 75% since then.
So CJ, do you think that we're ever going to return to the days when companies like Wix or HubSpot or Appfolio IPO with this sub 150 million in revenue? Or is this just the new gold standard?
I mean, like, maybe, but that would like be totally antithetical to everything we've seen over the last 5 years. But like, also Figma's up 157% on day one. So
Right.
I don't know anything. So there you have it. If you're going to IPO in 2025, you need at least $500 million in revenue, a credible path to $1 billion within the next 12 months. Growth still matters, no matter what they say. And if you want more on this, go to mostlymetrics.com. I break down every single IPO. I read through all the pages of their S1. It makes my eyes hurt, but I do it for you because I love the game. Go to mostlymetrics.com, check it out. And also, the algorithm overlords tell me that if you like and subscribe and even write something, you can say, CJ, your barber sucks. I'm trying to get a new barber. If you have any recommendations, do that and it'll help. Until next time.